Okay, everybody, welcome to week 5 of the Scipreneur Challenge. This week, we're going to have a guest speaker to help us talk about and discuss the topics of finances and generally everything you need to know as regard to finances. We won't go super depth, but going from what we've seen from him last year, it's going to be very informative, very instructional. And then, of course, we'll give you ways to reach out to him afterwards. And I'll introduce him in just a second. And we'll go over homework last week. The homework was great. I enjoyed reviewing all of them. I think everybody's getting really, really far along with understanding that product market fit. We'll go into channels and business development, and then also corporate formation and a few other things related to that before we talk about homework for the next week. This will probably be the last week that you have any kind of groundwork laying type homework before we start getting into the video and start getting into the pitch practice and building out your pitch deck. So without further ado, we'll go ahead and get started. All right. So as I mentioned, we're going to let Andrew Forsdick from Sage give us a good rundown on everything related to finances. And the important part that Andrew and I were talking about today that is going to be very relevant to when you're building out your deck is the forecasting part of that, understanding what your company can make over a period of time, but also understanding, it's going to cost you money to get there too. We're not going to go really depth to kind of understanding profit margins just yet, but certainly that will be discussed and a variety of different things related to that, as well as just some kind of general accounting information, because as a startup, obviously in a business, you need to be able to have that good hygiene as in regards to the finances on your business side. We will, and Andrew may go down and talk a little bit about funding. He is an investor here in town and has got quite a large portfolio with his and his business partners. But we'll cover more funding stuff next week when we go a little bit deeper into that as well. He's got about 35 minutes worth of presentation. We'll open up for question and answers after that, but we'll just let it go from there. So Andrew, really appreciate you being here tonight. And I'm going to hand you over co-hosting ability as well, so you can show us anything you need to.
All right, good deal. If I can I share? Yes, I can share.
Let me remove my pen. There you go.
This. All right. Okay, I'll go with the standard. Can y'all see my screen?
Yes, we can.
All right, does it say accounting made simple?
Yes, it does.
Okay. It doesn't have the little frame around it like it usually does on Zoom. So I will try to start the slideshow to make it a little bit bigger. And of course, I can't find it right now. Slideshow, there we go. Okay, so accounting made simple, sort of, because I guess for probably most of you guys, accounting is not simple. So what I want to do is just kind of go over the basics of financial statements, and then we'll talk about forecasts, and then I'll talk a little bit about financing concepts, things to understand with that, and then it sounds like y'all get deeper into that next week. So financial statements, there are 4 different financial statements, types of statements that you need to be concerned with. The 4th one I don't have listed. It's really just it's kind of minor, but these are the main 3 things you need to worry about: the balance sheet, the income statement, and a statement of cash flows. So the balance sheet is where the company stands at a point in time from a financial standpoint. So a balance sheet is always as of a certain day. And it looks at the assets and the liabilities and then how much equity is left. And I'll talk about that a little bit more in the next slide. Same thing with these other 2. An income statement is the profit or loss of a company, and it covers a period of time. So what occurred during the month of January? What occurred during the first 3 months or the first quarter of a particular year? What occurred? So those are always for the period, like for the year or for the month or for the quarter ended December 31, 2021, or for the quarter ended March 31, 2022. So that's for a period of time. So it's think of that more as activity, not at a point in time. Same thing for the statement of cash flows. It's a little bit different from the income statement. It's the same concept in terms of looking at the activity during a period of time, but it's focused on what happens to cash over that period of time. So balance sheet. A balance sheet, you have assets, liabilities, and equity. So, and then the assets have to equal the liabilities and the equity. So the assets can be tangible or intangible, and they're things that are of value to the company, like cash, accounts receivable, equipment, intellectual property. Those are the things that are assets. Liabilities are amounts that are owed to other people. So accounts payable, notes payable, accrued expenses, things that nobody has sent you a notice that you owe them money yet, but you know you owe them money. Those are accrued expenses. Equity is basically the difference between the assets and the liabilities. So equity consists of your investment, so what the investors have put in, and then the gain or losses that you've had, your income or loss that you've had over the years, which is referred to as retained earnings. So examples of assets: cash equivalents, prepaid expenses. A lot of times with you guys doing more medical device or medical related projects, I suspect that most of you will end up hiring some sort of engineering firm to do work for you, to develop a prototype of whatever device you may have. In that, they will, and maybe not everybody's doing that, but to the extent that you have something along those lines, a lot of times you have to put a deposit down with that engineering firm. So if they think it's going to be $300,000 of engineering work, they might require you to put $50,000 or $60,000 or $30,000. Some percentage of it they may require as a deposit. That would be a prepaid or a deposit. That's more of a deposit. Prepaid would be more like, you pay for insurance for the whole year and you write the whole premium, but then it covers the entire year. So a little bit gets expensed each month. Accounts receivable, you sell something, but they don't pay you yet. They're going to pay you later. Intellectual property, we know, the money spent to secure patent. Inventory, those are products held for sale. Fixed assets, you can see there, buildings, equipment, furniture, vehicles, etc. Liabilities, accounts payable, somebody does some work for you, they send you an invoice, you enter that invoice, those are accounts payable. Accrued expenses, somebody has done work for you, like let's say an attorney has done a bunch of work and it's December 31 and they haven't sent you an invoice yet, but you've spent $30,000. Well, you want that $30,000 to be reflected in the proper period when it occurred. So you might accrue those expenses. And then loans, to the extent somebody, a company has loans, those would be liabilities. Equity, two primary parts. You've got capital contributions and retained earnings. Capital contributions, it's the money people have invested, and retained earnings it's the running total of the net income or loss since inception. So most startups are going to have a net loss. The retained earnings are going to be a negative amount. And so let's say somebody's contributed $1 million, you've spent 500,000 of it. The net equity would be $500,000. The million less the 500,000. So your net is 500,000 of equity. Okay. Income statement. An income statement records, it's a record of the revenues and the expenses. Early on in your businesses, you probably aren't going to have a revenue, you're just going to have expenses. But the difference between the revenue and the expenses is your net income or your net loss. Since revenue is zero starting out for most of you, then it's going to be net loss. As I said before, it covers a period of time. So for the year end, the month end, the quarter end. And so think about the kind of comparing those two, the balance sheet and the income statement. Think about on a credit card during the month. Let's say you've charged, during January, you charge meals for your business, you buy some equipment related to it. And so you have those. So each one of those, that number for each one of those things is that you have some meals expense, you have some supplies expense, you have maybe you've charged some travel, some flights. on that. You have some travel expense. So those are all the expenses. The total amount owed on the credit card at the end of that time period, so those expenses go on the income statement. That total amount on the credit card at the end of the period, that is a payable. So that's a liability that would go on the balance sheet. And so let's say that's $500. Well, now if you bought a flight, then it's probably more than that. Let's say it's $750. So then you spend some more. You don't pay anything yet because you don't have any money. Maybe you pay the minimum interest amount, and then you charge some more stuff, and the balance at the end of the next month, you've spent another $750, and your balance is $1,500. So on your balance sheet, your liability is $1,500, and now your expenses during the month of February would be $750 again. So that's how those two pieces kind of work together. So revenue less the cost of the good that or the cost of sales that you are selling results in the difference between those two is your gross margin or the gross profit. Things that would go into a cost of goods sold are the things that it takes to make that. Something like a sales commission would not be part of cost of goods sold. Marketing expense is not part of cost of goods sold, even though that it's a cost to sell the good. It is not part of the good itself. So it's the things that the actual product, and you definitely need to have a positive gross margin. If you don't have a positive gross margin or gross profit, you don't have a business. So if you can't get more revenue than what it costs to have the item, at that point, you definitely need to fix one or the other. Then you have your expenses, which generally are going to relate to a period of time, compensation, research and development, legal fees, rent, admin, those types of things. And then that gives you what is your earnings before income taxes, interest, taxes, depreciation, and amortization, often referred to as EBITDA or EBIT. And then you take out your interest, taxes, depreciation, and amortization to come up with your net income. Statement of cash flows. So, well, let me back up for a second here. Well, I can't get out of it. Here we go. Let me go back and find the Zoom. Have I lost everybody? Anybody? You might have any questions? I know we said we'll have questions at the end, but if we don't have that part down, if anybody's totally lost, let me know. Everybody good so far? I don't see any hands. I see a few thumbs up and nods. That's good. All right. So I will, is it still sharing? Yeah, it's still sharing. Okay. So, all right. So the statement of cash flows, again, it's also during a period of time. It's for a month or for a quarter or for a year. And it essentially reconciles the cash balance. So what was cash on December 31, 2021, and what is cash on January 31, 2022, or March 31, 2022? And that's grouped into three things. And so it starts with the net income. And I think everybody here should understand that net income does not mean whether cash is going in or out. Think about my example earlier where you're going to have a deposit on your engineering work that you're going to have done. And let's say that deposit's $50,000. Well, you had cash outflow of $50,000, but you didn't have that expense. So on your income statement, you wouldn't have expense of $50,000. You might, let's say they didn't even start. You had to do that deposit and they don't even start doing the work yet. So your expense related to engineering work is zero. Your cash flow related to engineering work is $50,000 going out the door. So if you had $100,000, you started the business with $500,000, you've done this deposit for the engineering work and you hadn't done anything else, your expenses, your net income would actually be zero because nothing else happened. but then a reconciling item on your balance sheet, because you have that deposit and that change in that balance sheet, you would have a negative a cash flow related to an operating activity, because that engineering work is an operating activity. So you would have negative there of $50,000. Now, if somebody had put that 500, and then the investing activities are things like buying equipment, selling equipment would have inflow. Those are the primary things for investing. Financing is how you finance the business. So if an investor, even though that's a little tricky, if an investor's putting money in, that's not an investing activity. That's the investor's investing activity, but that's the company's financing activity. The company's investing activity is if it bought equipment. So a financing activity would be like that, 500,000. So month one, an investor invests $500,000, and you take 50 of it and make a deposit on the engineering work. So in the month of January, we're saying this all happened in the month of January. In the month of January, your cash flow would start at zero. Your statement of cash flow would start at zero. Operating activities, it would have minus $50,000. Financing activities, it would have inflow of 500,000. So the net of that is a positive 450,000, which would equal your cash balance at the end of the month. You started with zero, you got 500 in as a financing activity, you spent 50,000 as an operating activity, and so that difference is 450. And then that's what your cash balance would be. If in the second month, let's say you bought a machine for $100,000, but didn't do anything else, you just bought a machine, your cash flow for that month would have zero related to operating activities, negative $100,000 for investing activities, and zero for financing activities, and you're down to $350,000. So those are examples of items that are on your statement of cash flows. Those concepts are important to remember as it relates to something that I'm going to show you a little bit later on the forecasting. So let me pause there and go back to where I can see y'all. Any questions on the types of statements? Balance sheet, income statement, statement of cash flows. All right. So I've either got everybody asleep or everybody's following, and I've kept it simple enough so far. We will continue. So forecasts. Forecasts are your best guess of what's going to happen in the future. They always look good, and the main reason they look good is because they're completely made up. If your forecast does not look good, then you definitely don't have a business, because if you can't make up good numbers, well, then the business is not it is sort of doomed. So forecasts always look good because the numbers are all made up. But the key is what are the assumptions underneath it? And then you also, I'm going to talk about all these different things, but is it what I kind of refer to as connected? Is it connected? Is it defensible? And the focus is going to be on the income statement and cash flow in these early years. And I would imagine most of your businesses are not very intensive with respect to capital equipment. And so the balance sheet doesn't really matter a whole lot. You got to kind of pay attention to accounts receivable and be careful about that. But otherwise, the focus really is on the income statement and the cash flow part of it, which sort of takes care of the balance sheet, but really on the cash is what you're worried about. There's a term that's often used about called burn rate, and I'm going to talk about that here toward the end. So the best guess of the future. What are the key expenses going to be? What is the product development cost going to be? What is your timeline? Because during that timeline of the product development, you may have core expenses like your compensation, insurance, maybe rent somewhere. You have those things ongoing during the product development. And then you got to figure out, when will revenue begin? Well, revenue can't begin until after product development is finished. And then, what is that level of revenue that is expected? Being able to do those and understand the whys behind those are really, really important. So as I said, forecasts always look good because they're made up. Again, the assumptions are really key. What are those key assumptions? If you think that the development is going to cost $300,000 for your product, is that because you just heard somebody else's product cost $300,000 to be made? Is that because you hope that that's what it is because that's how much money you think you can raise? Or have you gone to an engineering firm and gotten them to give you a quote for how much it will cost? If they told you 300,000, are you just banking on that 300,000, or did they tell you 200 and you're padding it and calling it 300? Have you talked to anybody who's used that vendor before and asked them how close was the initial quote to how much they actually spent? Those are the types of things of getting underneath that to understand what those key assumptions and how those assumptions are derived. And you can verify them with vendors. Things like marketing. Are you comparing those to the industry norms and finding out where as you get more developed, you have to, and get further along, you have to get more specific with them. At an early time period, you probably shouldn't spend a ton of time trying to develop a marketing plan, your go-to-market plan, with specifics on the dollar amounts. You need to have an idea of what that generally will cost. But if you haven't even developed the product and you don't even have a proof of concept yet, you're probably you're just guessing. You're just totally guessing on those other things. You need to have some sort of an idea about the range of how big something can be and how much you can sell of it, and have an idea that yes, there'll be enough room to do the marketing and the people and all those things to be profitable. But trying to get too granular too early can be a little bit of a mistake. But you need to know that it's and then the biggest thing is timing. Are you using somebody's just their estimate of their time? If the engineering firm told you it would take 4 months, are you using 4 months assuming everything's going to go perfectly? Because I can promise you there's a very, very high likelihood that it's not going to go all according to plan and it's going to take longer. So is it connected and is it defensible? By connected, what I mean is, do the various costs and the revenue sort of match up in terms of timing? So if your sales are $100,000 in a particular month, well, what does that mean? And again, this is as you get a little more mature and you need to really start thinking about the pieces. Okay, how many salespeople do you need in order to sell $100,000 worth of product? If you are showing $1 million worth in a month, or okay, and you only have one salesperson, can one salesperson really generate $1 million? No. Or if you say that you have 25 salespeople, but your communications cost is $500, well, you're not spending $400 per salesperson on communications. You need to have in there $100 a month at a minimum for a phone and for internet and all that. So travel, does your travel and your number of salespeople match up? So that's what I mean by, is it connected? Does all that connect together? Marketing versus the amount of sales. And then the other thing you got to think about is when you start getting more toward the sales side, if you say, okay, we're hiring a salesperson in January and we make our first sale in February. Is that realistic? What is it? What is the norm in this industry that you're selling into? That's probably doubtful. You may need to hire a salesperson, and the next thing when they can create revenue might be 3-4 months down the road before any revenue can come from that salesperson. So having that proper lag in there. And basically, do you have good sources? Are you pointing to something, or do you just kind of, taking a guess and hoping that you're right? So early on, focus on the income statement and the cash flow. Some investors, some VCs might ask you to see a forecasted balance sheet. It's really not that hard to create them because you're probably not spending a lot on equipment or things like that. But you do have to focus on your cash flow. And when you look at the adjustments from income to your cash flow, those can easily be translated into a forecasted balance sheet. And the most important number on that forecasted balance sheet typically is going to be the cash, which most people are going to track and try to figure out anyway. The way that, accounts receivable, if you sold $100,000 in March, but it's all on accounts receivable, well, then you have to back out the $100,000 of revenue to get to your true cash. Remember our cash flow statement? So you have to do that to get to your true cash. Now that next month, you can assume that you collect it, but you also sold $200,000. So compared to your income statement, you've collected last month's 100, but you sold 200,000 on accounts receivable. So there's a negative 100 in that month also. But typically what I see is you do your income statement, and then below that you have the adjustments to the cash flow to kind of reach a running cash balance. And what I like to do is I do those, and then I don't put any investment in there, and I let it run out and see how far does it go negative before it starts to turn positive because of revenue and gross margin and net income. And then when it starts to go positive, you look at that maximum negative number, double that, and that's probably how much cash you need. Not necessarily double it, but early on, it's going to take more than your best hope in that forecast. And the last thing I'll say is I don't like the term burn rate because that means different things to different people. I find it to be a fairly ambiguous term. Some people might refer to burn rate as how much are you spending each month? If you don't have any revenue, it's sort of the same thing. Whatever you're spending each month plus is how much is what most people refer to as your burn rate. That's your negative cash flow each month. But other people might look at the burn rate, particularly if you have kind of the core expenses of insurance, communications, and salaries for the core people, but you're outsourcing engineering to somebody else. Well, one month that engineering might be $50,000. The next month it might be $20,000. The month after that, it might be $100,000. So that's real uneven. And to me, it's not one of your core expenses, and it will end. When that project ends, it will end. So if I'm 2 months away from finishing my engineering and I'm spending $20,000 a month on employees and a phone and some insurance, but I've got $100,000 that I need to spend in the next 2 months on engineering, 50 a month. Somebody may say, what's your burn rate? Well, for the next 2 months, it's 70,000 a month. But after that, it's $20,000 a month. So my ongoing expenses to keep that part of the business going are a lot less. So I don't like the term. I prefer negative cash flow. What is my negative cash flow? Or what are my core fixed expenses? Or what are my expenses? So all three of those could be what somebody is referring to when they say, use the term burn rate. So again, I'm not a big fan of that term. So let me pause there and stop sharing for a second, and then we'll jump back in and look at valuations. Are there questions on forecasts?
I have a general question. So when there's no cash flow, or like you are pre-revenue and you don't know how much money are you going to make really, and you're doing like first rounds of investment pitches. So how do you decide your company's valuation, or how much money do you really ask for how much equity?
Yeah, so that's a good question. And actually, when I jump to the next slide, that's going to help answer that in terms of how some of that works. So to answer your question, it's you have to do some sort of a calculation to have an idea of how much money it can make. So if you're developing a software application that's going to be sold into the medical space to help hospitals save money, or help physician practices save money, or better manage patients, or whatever it is, you have to do some sort of work to look at how much is being spent in that space right now. How many hospitals are there? Are you selling to only hospitals that are in rural markets? Are you selling to only diabetes clinics? Are you only selling to orthopedic doctors? Are you, what, you know, so you have to do the size of market. And I'm sure, you know, Brian is going to have y'all do those things if you haven't already started doing those things, and looking at your total addressable market, which TAM, you'll see the TAM, your total addressable market. Then you'll see SAM, your serviceable addressable market, because it may be that you know, in theory, and that's kind of what's in theory and what's realistic. In theory, you might be able to sell to any physician practice in the United States, and so that might be $1 billion. But practically and realistically, what you might be able to do is only sell to ones in the Southeast for now, or for whatever it may be. So that may be your serviceable addressable market. And so it's going to be, maybe it's only $100 million. So you look at that serviceable addressable market, and then there's some sort of assumptions of, okay, we think that if we get this many people and we do this, and, you know, there are already 10 players in that space, nobody's a dominant player. We think we can carve out and get 20% of the market because we're bigger and better and whatever. Well, how much money would the company be making if you achieve that? And let's say it's going to take you 5 or 6 years to achieve that. And so in 5 or 6 years, you got 20% of a $100 million market. So you're selling $20 million. And let's say your net income on that is $5 million. And companies like that trade at, to get sold, somebody is willing to buy them at 8 times the net income number. So you had 5 million, somebody will buy it for 8 times that. So you think that in 5 years, you'll be able to sell it for $40 million. Well, if you need $1 million today, whoever's investing that $1 million wants to get a certain return, right? And so let's say that they want to, let's say you're going to sell it for 30 million, because this is going to help me on my next slide, since I know what's coming up. It's going to sell for $30 million, and they want 10 times their money. So you need $1 million, and whoever's put that $1 million in wants 10 times their money. So they want $10 million in 5 years. You think the company is going to be worth $30 million. You could sell it for $30 million in 5 years. So how much of it do they need to own to get 10 of the 30? Well, they need to own 1/3 of the company. So that's what you would, when you're doing it, when you're selling part of the equity, they would buy 1/3 of the company. That's one way to do it. That's one way to look at it. Does that sort of help answer the question?
Yeah. Thank you so much.
Okay. Now, that being said, that was a nice, neat, clean, and easy answer. Go find the serviceable addressable market, figure out how much of it you're going to get, figure out what you're worth at the end, figure out how much they want, all that. That's easy to say, but all that's really, really hard to do, because you really don't, you can't really pinpoint exactly how much you're going to be able to get of that. Justifying why you think you're going to get 20% of that 100 million is really difficult. They're going to discount that and say, you're not really going to get 20%. You might only get 5. Well, if it's that, and then it's worth this, and you're not going to get an 8x multiple, you're going to get a 6. And yes, there's all kinds of sort of negotiation around all that. But that's, those general principles are what a lot of people are going to look at when you're talking about a pre-revenue. The other way they might do it is they may say, hey, pre-revenue company, we expect it to be, sort of big market. We're going to roughly say it's, on the low end, a $2 million pre-money, and on the high end, a $4 million pre-money, because that's just what they do. That's just what they're going to assign to something. You can paint the prettiest picture of how big something's going to get, but if you have 0 revenue, they might still balk at some big number. Ultimately, that value is what somebody's going to pay for it, what that investor's going to pay. So that's a great segue. Your question is a great segue to this next part. So valuations. Valuations are used to determine the purchase price of an equity investment. You typically are talking about pre-money versus post-money. It's just what it sounds. Pre-money valuation is the value of the company before the investor puts the money in. The post-money valuation is that pre-money plus the amount of money that was put in. The pre-money valuation ultimately is determined by the investor. You can propose a value at which somebody is going to buy equity. You can say that your pre-money is $4 million or whatever you hope or think it could be. But ultimately, the market will decide what that value is going to be. So this is an example that I kind of gave when we were talking. If the pre-money valuation is $2 million and someone invests $1 million, then your post-money valuation is $3 million, and the investors will own 33%. So they're going to have 1/3 of the 3 million. Therefore, they get 33% of the company. And then to sort of check the value and check this is you take the 33% times the $3 million and it equals $1 million, which is how much they put in. So that makes sense. And then let's say the management, let's say, owned all the company on the pre-money side. So the management sides on paper would be worth a couple $1 million. So any questions on that kind of pre-money, post-money calculations? Nope. Okay. So yeah. So in terms of doing that and doing the valuations, there's a lot of negotiation about what goes into that pre-money. A lot of times what happens also is, investors going to say, okay, here's what the pre-money valuation is, but also you have to factor in an options pool. So it's the investors plus the options pool. So they already know they're not going to get diluted by those options coming out later after they put their money in. You have to account for that first. They may have some options they want set aside for board members, and then they're going to be a board member. And so then they may get some options that way, particularly lead investors may do something like that. So that's my overview, and hope I went over a few minutes, but had a couple of questions in the middle of that. So other questions related to accounting, finance side, valuations, any of that stuff. I know a lot of it is kind of overwhelming.
Yeah.
A floodgate of information, particularly. Do any of y'all have business backgrounds, or most of y'all have science backgrounds?
Well, that's what I was about to say. It just to kind of let people off the hook a little bit, right? Because most everyone here is on the science side, but I'm on the technology side, I'm on the startup side, I'm on the business side. And the thing I just really don't care for, not that it's a bad thing, is the finance side, like going and asking for money, proving how much money we need, doing all the funding side, that I can handle. But I reach out to people like Andrew and people like, other individuals that we know in their network to help me, right? Or to bring them on as a fractional resource, to be our CFO, or to be something that would actually allow us to do the accounting. So it's one of those things where, if this is not your comfort zone, you also don't have to, risk or beat your head against the wall. There are a lot of resources out there that will do this with you for large businesses, for small businesses. Andrew and Sage are definitely one of those companies that do that. There's others as well, all around the country and the world, that will help you with that regard. So you don't have to go in this all by yourself. This is that scary area that you just want to try to avoid, but it can't be avoided from a business perspective, right? So you might as well get the right person.
And for sure, I was going to say that. Make sure that when your ideas start turning into businesses and you start spending money, whether it's your money or friends and family, that sort of thing, make sure you get somebody to do some bookkeeping. If you can do it yourself, great. Get somebody to do some bookkeeping, even if it is as simple as taking a Google sheet and having all the checks, all the outflow that you have, and put it in columns of where the expenses are going, somebody can sort of start to make some sense out of that.
Yeah.
But better yet, a simple little like Zoho or QuickBooks. Those are accounting packages that you can record stuff on in those and keep up with that, so that if somebody says, what are your expenses like, you can produce something that shows them what you have.
Yeah. One approach I take is like, in the first stages when I'm putting together the team, obviously I'm focusing in a lot of different areas, but a bookkeeper, right? Someone to kind of manage the accounting and finances in the earlier stages. And the reason I was saying that is I also want to stress the point, like when you have launched into a market and are getting good market share and you've taken on, late seed or early series round, you have investors behind you, you really need a CFO in that regard, because it's not just about bookkeeping, which is a must, right? We call it hygiene because it just needs to be in your everyday world. But a CFO also will be part of that revenue stream, part of that revenue understanding, part of that funding understanding, part of that future growth and strategy and how it needs to be supported through finances and everything else. So a CFO is a very important role, but you can kind of get away with the accounting stuff early on by either farming it out, hiring a bookkeeper, or just doing it like Andrew was saying in Google Sheets. And so, that's what I always do for like the first year that I'm in my businesses. And then I start, expanding and putting people in the right places.
Yep. That is that's very good. I was going to say one of the things, financing. Y'all talk about this next week. It sounds like on more the finance side and sources, but a little teaser there for you on that. I always say, and people are shocked to find out that typically banks are the first investors in startups. And when I make that statement, a lot of people are shocked because they think they've never heard of a bank investing in a startup. But the way that works is entrepreneurs run their credit cards up. And so when they're maxing out the credit cards, the banks unknowingly are investing in your startup. So, and then the next ones after that, after the credit cards are maxed out, then you do what you do, like you did back in college. You turn to your parents and friends and ask them to help you out. And so that's, the typical friends and family round. And then at that point, you need to have enough validation to convince somebody who is not necessarily a friend. They can be friendly, but they're going to do it because they think it can turn into something big, not because they like you. And that's kind of that difference between, the difference between an angel and a friend and family investor is that an angel's doing it because they're wanting to try to make some money. They may like you also, but they're going to see a return. Your friends and family are going to pat you on the back and tell you it's a great idea, whether they think so or not. And they'll give you a little bit of money depending on how much they give you, will depend on how much they really believe in your idea, but they'll probably give you a little something just because. That's, a lot of times how it goes. So don't necessarily take that as validation. When you're testing your ideas, go ask people. And I'm sure Brian's putting you through the ringer on this in market, product fix, all those things. Ask people who aren't your friends. Ask people who don't know you, because they're more likely to tell you the truth if something is not all that great. Friends and family just are going to have a hard time telling you that your dog is ugly. So yeah.
We have stressed that. I'm going to have to steal the dog is ugly thing because I didn't say that, but yeah, that's exactly right. And we've talked about we've hammered customer discovery. Customer discovery is not just about customer. The word discovery is also about your financial resources and your funding sources and so on and so forth. So, and we're going to jump into that next week. We're going to recover some ground on the forecast and what the expectation is for the pitch. We're not going to go super, super deep like a lot of startups have to do that are in a longer program pitching for money, but we are going to at least get to a point where we have some sort of forecast and some sort of ask, right? We want to set some expectation around what we would need to get an MVP into the market. So are there any other questions for Andrew and his topic for tonight?
If y'all think of something later, you're welcome to reach out. Also, I'm going to share and show just a couple more things really, really quickly. This deck is sort of a summary of this Google Doc that covers all those things that I talked about. It's really just a Google Doc with all the slides. it gets into a lot more in the income statement, explaining what these things are for. Statement of cash flows, it explains a little bit more there. It gets into the forecast, all that stuff that I said is in there. Valuations, it goes into a lot more depth on the valuations. So it has those first examples I was giving you that starts telling you how to, calculate share prices and things like that. And what if it's a different valuation and those types of things. Then I have some assumptions to kind of walk somebody through what happens from a accounting standpoint. So like in month one, the company gets $10,000 from an investor. Well, over here on this Google sheet, which I'll export to Excel, and then I'll also export the other to a PDF. So month one, you would debit cash and you credit investment. Let's call it investment from investors to be clear. And then, month two, the company buys 5,000 units of inventory for $5,000. And so it goes through and, okay, what have you done? So here's what happened. You bought the inventory. So cash went down $5,000 and inventory went up $5,000. Nothing happened to income because nothing was sold or bought. You just took one asset and turned it into a different asset. So this walks through, and at month three, month four, it has different things that occur. And the spreadsheet, the corresponding spreadsheet each month shows you what is happening on those things. So I feel like it's a good sort of beginner accounting product. I think Brian looked at it last year, or the year before, and gave me a little bit of feedback, and I've tweaked it a little bit since, and I've had a few others look at it. So I'll send that to Brian or Shelby or both of them, and then one of them can get that out to you guys.
Yeah, we'll put it in our Google Drive. I moved the ones from last year over, but if you got new ones, we'll replace those with the new ones.
These are the same. Okay. I think they're pretty much the same. So yeah. I had tweaked.
I've got the spreadsheet and the PDF for the accounting forecast valuation simplified for entrepreneurs, but I don't have your deck. If you want to share that too. So,
okay.
But that's great. Yeah. So we have the material up there. So everyone can ask questions through email. We'll pass them on to Andrew. We'll make connections there. Also, he's leaving the material up on the Google Drive, which is a fantastic resource. I mean, I love it when we have guest speakers that actually leave things behind as well for you to kind of digest. We covered a lot of ground tonight. Obviously, it wasn't super in depth, but it was super informative, and we really appreciate your time, Andrew.
Well, you're welcome. The on those resources, I'll brag a little. My daughter, my youngest child, second daughter, youngest one, freshman at Loyola up in Chicago. She switched from a biology major. She was going to be a veterinarian. She was taking biology and chemistry. She changed to an accounting major. So sort of a big switch there. But I gave her those, and she went through those resources, and she's got an A in accounting so far. So,
all right. Well, now we can all go take an accounting class.
There's a science person who has transitioned to business, and she's doing well with it. So hopefully it'll help you.
It can happen. That's actually what we're trying to do. We're trying to put another hat on all these science people, so they have a business hat and a science hat. So we really appreciate you helping us with the financial side. Thank you very much.
All right. You guys are welcome. Good luck.
All right. Take care.
Yeah. Bye.
Okay. Let's got a few more topics to discuss tonight, and we can get it done in the next 40 minutes, I'm sure, but we'll take our time and get through it. So that was a great rundown of the finances from Andrew. Again, we're going to go deeper in this next week when we talk about funding, and we'll put the two pieces together, but mostly from the forecasting side and the ask side, which also gets you to a little bit of valuation. We'll walk through a little bit of an exercise. I think at this point, valuations are going to be very subjective. Obviously, a good practice is to do a lot of research, ask a lot of people, talk to a lot of people, and even retain a CPA that specializes, or a lawyer specializing in valuation. There's a process for it, and there's a lot of factors that go into it, a lot of integers that actually go into it to lead to a valuation. Plus, there's also X factors of what type of business you are, whether you're technology or not technology, something like that, healthcare, not healthcare, retail, otherwise, CPG, you name it. So it also kind of affects that when you're looking at your forecast, your overall valuation. And in most cases, the people that y'all are, because y'all are leading experts in your areas and you are patent holders, your value is actually greater because of what you bring to the table. So the team can and often does play a part in valuation too. A little bit more subjective, not a lot, but certainly a factor to be considered by investors. And we'll also talk about that conversation with the funding sources and kind of how to negotiate, right? He talked about pushback, right? Where you're saying it's 8X and they're like, no, it's 5X. Well, if you're really convinced that it's 8X and you can show that with really legitimate background data, they might be pushing back for a lot of reasons that aren't actually to your benefit, but to theirs, right? So we'll talk about that too. All right. So let's go over homework real quick. I thought it was a lot of great stuff. Let me go back a slide. All right. So let me share. I mean, I think y'all are really, really coming along very nice with that, with the work. Okay. All right. Move this down a little bit. All right. So we'll start off with team one. All right. So here's our homework. Yes, the value proposition. They discussed two customers. One was a drug manufacturer. The other also was the gene therapy companies. Really like what y'all did here. You broke down very well. So talking about pains, a wide range of diseases require chronic dosing. The current LNP delivery method is unsafe. I mean, these are actual pains to an eventual user, or in this case, the drug manufacturers. And the current LNPs will not effectively treat chronic diseases, will create additional problems and in patients. And then, what are the gains? Obviously, you could go like, and I'm glad you didn't really. I mean, one thing is to go, oh, well, it's just the opposite of pains, but it's not. I mean, you also have to look about that. It's, what really could also additionally deliver gains that are not just a delivery of something that alleviates pains, right? So, there's a risk there of people just kind of doing the opposite, but that's not what y'all did too, but did either. So that was great. A way to deliver chronic treatments of a drug payload, precise targeting of tissue. That's a big one. No immune reaction and low cytotoxicity for drug delivery. Also a big one. So those are really good pains and gains there. Job to be done, offer the customer a drug delivery method capable of encapsulating and delivering gene therapy payloads that can prevent or treat disease. Obviously, yeah, that's great. Ultimately, with a method for safe and effective payload delivery, a large market space will open for further development of translational gene therapies for patients and to move promising preclinical therapies into humans. I like this one because this one actually talks about what will come after you lay the groundwork with your product, right? So you're actually looking at this as more of like the stretch, right? This is what happens to the environment, the economy, the market space that you're affecting by your technology, by your disruptive or innovative product. And so it opens up a host of, kind of thinking around what can be extend from this process. So that's good. Then great in the value proposition. Love it, right? Because you took the pains, you took the gains, you reworded them to actually deliver on those things or create those things. And I thought that was really good too. And you did the same thing for the second customer too. So I like how y'all really looked at both sides of it. So you kind of have a multi-segmented product opportunity here. Same with the other one. Currently can't get gene editor payloads to the right tissue. These are pains that the gene therapy companies are facing with their current products. Gains, a delivery method for gene therapy product that would go to the precise location. Targeting is big. I think that's a good value proposition. Those kind of terms. And so just so you know, I mean, if we take a pause right here and think back from week one, where we talked about, starting off with an understanding of, first of all, how to be creative around your solution and deliver, around the problem to deliver a solution, but then also going into the problem itself and properly crafting and framing the problem into something concise that can be digested, and then looking at the customers and starting to identify those customers that are going to be most effective through pains and gains for that, building value propositions for them, what you're doing now, applying the solution statement to match up to those three things, utilizing now also to pick on keywords that you think are going to be very effective when you're talking about this, right? So when we talk about this, like targeting is a very, good keyword. And what I'm leading to here is like what we'll talk about at the very end is coming up with your 60-second elevator pitch script. This is all the content that you need to kind of extrapolate that pitch script from, right? Because you have a pretty nice roundabout way of talking about it. So these are all the pieces you need. So after seeing all the homework tonight, I really feel like y'all are very close to having everything you need to start working on that elevator pitch, start building the narrative, start finding the keywords that are going to resonate with your audience. And those revolve a lot around this information that we're talking about right now. So any questions from team one? I thought you did a great job. I've re-looked at some of the other material too. I think everything you'll have is shaped up to everything you need to do what I just said. All right.
Yeah, I don't think I have any questions at this time.
Okay, good, cool. All right, so let's move on to team two. This is great. Love this. I thank y'all very much for kind of reproducing the visual with your things. So we have two for this one as well. So looking at the value proposition canvas here. So on this side, the product service is the engineered seed, gain creators, performance, quality, and fast growing crops. So, overall performance. So your yield is high, the quality is good, and it grows faster, right? So you have quick, it's not just increased ROI, it's it's a rapid, acceleration to ROI. These are great gains, cost reduction, risk reduction, and convenience, right? So when you're looking over here about, what they want to get, these individuals, is more productivity, more ROI at a reduced cost with less risk and breakage, meaning just stuff you lose, quicker, and something that doesn't devalue the land, something actually increases the value of the overall land because the throughput and the yield and the quality is all increased, right? So obviously the production of this is also more valuable. This is great, right? I think you have two sides of what we're talking about here. You have how to quantify in words what the pain points are, and then also how to quantify in words what the gain creators and the pain relievers are for the product of the engineered seed. This is good. All right, so here the product is the engineering service, the multi-parallel screening, fast generation of new seed, quality control. All right, so then just kind of looking over at the jobs, this time it's kind of going from the backwards, we went from the forwards earlier. So the agrotech, generate new seed for market, propose new options, resistant seed, better quality, better ROI on seed. The gains, long life product, customer loyalty, and dependence. We talked about loyalty last time, right? Both is something that you'll have to break into with your product, but you also want to reestablish loyalty. I mean, I'm glad y'all put that in there. It's not always obvious to say that, but that is what you're looking for, is that brand loyalty. That should be everyone's goal, but you're going to have to replace something that has been utilized for decades, right? In some cases. So for y'all, I think listing this out, considering that it should just be a norm for everybody to go to brand loyalty, for y'all, I think you're going to have to really make sure the campaign enforces brand replacement and brand loyalty. So, I mean, that's something to consider. And I'm glad you put it here. The pains, costs are always a pain. That's good. I'm glad you put it in there. Time to test each prototype, success rate very low. So it's time consuming, and the success, the output, the throughput is not great, right? So then going back to the opposite side of this, the gain creators, a big catalog choice with new options, no GMOs, better imaging, new opportunities targeting chloroplasts, pain relievers, decrease cost. Again, that's important. Decrease research to market time and risk reduction. So yeah, I mean, even though they're kind of the opposite thing, that's what I'm saying. And I've said earlier, it's right. They are interrelated. They're very dependent on each other. They shouldn't just be the absolute opposite. And that's not what I'm seeing here. So that's good. But the way I'm saying is, like, you have put these kind of things in two different terms and two different narratives. One's very positive and one's very negative. That's what you're going to put into your elevator pitch. That's what you're going to put into your final pitch as well, those elements. All right, any questions from team two?
I have just one question. Can we segment like this two different service or product, or should we have just one for one team? Because when we do a pitch, it's complicated to give two different, like for one service and one product, different value proposition. Or should we do an average of both service?
I think there'll be commonalities between both, but if they're distinct customer segmentations, they might and probably will have their distinct value propositions. And I might understand, I think I understand what you're also asking here. It's like, how many narratives do I need? Well, you need an overall narrative to kind of encapsulate everything. The generalized one, the one you'll present to a large audience or just a generic audience of a variety of different people. There's that narrative also that you'll kind of form over time as you're talking to investors. We'll really format in this process, maybe more than the one that you format for customers. So the business side, the investment side has got its own narrative. And then the customer side, especially if you're talking to businesses, that's got its own narrative too, but they all fall under a basic same thing. where I like to look at it is like, what are my stress points, right? If I'm going to be presenting to investors, I'm going to stress on ROI. I'm going to stress on big pain and big market opportunities, because as Andrew said, that's what investors are looking for. They're looking for X return on investment. If I'm talking to customers, I'm going to spend a lot of time talking on alleviating their pains and giving them some gains, right? So we're going to reduce that cost. We're going to reduce that time to market. We're going to give you better quality and better, just better product overall. So I stress those points. So it's really more like taking the overall narrative and then pivoting your focus on the audience, right? And if there's no focus for the audience, then just the generic kind of overall narrative will work. Hopefully that was the answer to your question, but if not, let me know.
Yeah, thank you very much. It's just sometimes it's easier to sell a product or service. For example, to sell a product to farmers is easier, but the service can make more money, but it's more hard to convince investors. So should we choose the one that is easier to understand, or to take the one that can be more interesting for the investor? Like it's,
well,
that's I think it's enjoys.
Yeah, that's actually a great question. So let's talk about product segmentation, right? So you have a product that you're going to put out in the market, and that product's going to collect data, and that data is very important, both in the aggregate, but also in the collected, right? So if you've got that kind of component, I'm kind of loosely talking about this, the same thing you're talking about, but just kind of putting in a generic example. It's like if you have those products, one actually comes before the other, and one narrative kind of affects the other narrative as well. But the end reason why that customer is buying either the upfront product or the back end data are for completely different reasons. Maybe a little bit related because they want more insight about the customer, but still it's like I'm looking for different things. One, I'm looking for research data, and the other one, I'm actually looking for product yield. And so over time, you will form those narratives that move into that. But just know, like, if you have that kind of multi-segmented product where there's a cart and a horse, the horse, and then you put the cart on it, you really need to start with that horse and then build a cart after, as far as that narrative goes.
Thank you very much, Brian, for your answer.
Yeah. All right, team 3. Okay, so thanks for the color coding. That helped me a lot. I was kind of going through at first, looking at it, just make sure I could figure it out. It is just for general feedback. When you're doing these things, just kind of label the stuff so we kind of know, and it will help you more than it helps me. I mean, it's just so you can kind of break it apart. Now, you probably did something like that to formalize these paragraphs. So I'm going to give you the benefit of the doubt and say that, because as I'm reading it, I actually can pick out the pains and gains through that. So, the customer of this type is dedicated to exploring the therapeutic significance of TRPC3 inhibition. I'm going to skip that word. Thus, they have to figure out the prototype of TRPC3 inhibitor, got it that time almost, which can be used in R&D settings. The customer would be delighted when the prototype TRPC3 inhibitor, JW65, shows superior properties in terms of solubility, brain permeability, potency, and toxicity when compared. Nevertheless, the current standard inhibitor compounds displays low solubility and tremendous toxicity. These features of PO3 made the customer frustrated and have significantly blunted the customer's research interest in the TRCP. Hence, the new TRCP inhibitor JW65 should relieve a majority of the pains of the current standard, thus reinvigorating interest in TRPC3. All right, I can discern some pains and gains, but I think the way y'all kind of approach this, and I apologize if I kind of gave you the indication that this is the direction, and I'm not saying y'all have done a bad job at all. I think you have all the content here, but I think probably breaking it down into the individual parts and then researching those individual pieces and just kind of putting in the things that, exhaustively, like exactly as much as you can, what is causing the pain and what is going to generate the gain, right? So I get part of this, but I think probably just a little bit more thinking on the pains and gains, unless somebody wants to kind of, reach out to me right now and kind of talk to me about more and kind of give me some more insight into y'all's approach. All right. So again, y'all did 2 customers as well. I think that's really great because you have 2 things, because one is about the researchers, which I think are a very good customer for y'all, but the patients are also something that's very, a group that's very important. So the epilepsy patient who has shown multiple drug resistance, because we're talking about, right. And to me, let me go back. So the researcher, this is fine. The narrative here can be very scientific, can be very, very detailed. Don't stress on, and I'm going to say this with a caveat, don't stress on this part when you're talking about the researcher, going back to what I've already said, like having two different segments that you're pitching to. You don't necessarily have to shy away from some of the uglier bits, right? That might need to be in here that they can really, understand and relate to. When we're talking about patients and healthcare and kind of human-centered kind of stuff, when it's on the other end, yeah, that's when you can kind of change it and kind of, layer in more of the pain related to them not being able to have an episode-free life, right? And I think that's a huge value proposition for target customer number 2. I think here in customer target number 1, the researcher interested, they're going to be very, very interested in everything that it can do and everything that their current products can't do. So that's just another kind of bit of feedback there. You can actually go a little bit further when you're talking about talking to the researchers. I think the best way of saying it is just like know your audience and be able to pivot your overall narrative to best suit your audience. Same goes with farmers compared to the manufacturers of other products, seed and otherwise. All right, let me just run through this real quick. The epilepsy patient who has shown multi-drug resistance to current anti-epileptic treatments, the patient who is currently unable to achieve seizure freedom. I mean, that's definitely a pain. To ensure the security and quality of life, the customer of this type is urgently seeking an available medication that can effectively reduce the severity and frequency of out-of-blue seizure attacks. The qualified immediate medication would allow the customer to enjoy a joyful life with seizure freedom. Yep, that's certainly a gain. Nevertheless, no current anti-seizure medication can provide such benefits. It maybe in this area, if there is some reasons that are fairly typical of why they are resistant, you could put that in here just to kind of further hone in on your customer base. Are they epileptic patients with certain markers, or are they just it could be anybody who's just generally resistant to this kind of stuff? I don't need an answer now, but that's just something to think about. Here, our product JW65 represents an alternative candidate for the treatment of recurrent seizures. JW65 is believed to provide a portion of customers of this type with a new hope to enjoy a truly seizure-free life, given that it has shown great promises in not only reducing seizure severity, but the frequency of seizure attacks as well. Team 3, I think you're actually might be closer to where your 60-second elevator pitch script is than the other 2 teams. They've had theirs a little bit more granular, right? I think y'all did the deep thinking, but then kind of paragraphed it, right? And that's okay. So here's my challenge to y'all. Make sure you go back and think of all the things that you could truly bulletize as pains and gains from both your customers. Make sure you have it all covered with what you're doing here. And then make sure that the sentences and everything that you put here, the script over these 2 things kind of matches up to that. I think you're going to have to go on a word diet to kind of get all these things in. You also need to talk about, how and this goes for the other teams too, is like how you'll cover both sides of your customer segment in your 60-second pitch. That's going to might be a little difficult for you. So you're not going to be able to spend a great deal of time. So for each of your customer segmentations, you might pick one pain and one gain. There might be several, or you might collapse them together. Like the farm one, I think you could actually say a few keywords that all, high yield, low breakage, time to market, those kind of things. You can put those all in one sentence. This one might be a little bit more difficult because it's a little bit more technical in this regard with the 2 segmentations that you have. So I think this is all great. I have no problems with this whatsoever. It seems almost scriptish in its current form. So I think you're probably a little bit closer there than the other 2 teams, like I said, but everybody is right there. So I'm really pleased with everybody's work and everybody's pace. And I can't thank you enough for that. The participation has been fantastic. Okay. Any questions for team 3? All right. So we do have a couple more topics. So let's go ahead and go through those. All right, so I want to talk to you about channels and biz dev. This is those 2 blocks on the canvas as well that are all the way to the right. The one that's at the top is called channels, and the one at the bottom is known obstacles. So we'll talk about all that tonight in the next 20 or 30 minutes. There is some kind of discussion around channels and what that typically involves on the other canvases that are out there in the market. Typically, they focus mostly on marketing in that regard, inbound and outbound. to me, being a former supply chain person and manufacturer, fabrication person that's done a lot of those things, I think it doesn't cover everything when you just talk about marketing when it comes to channels. Channels are a lot of things, and this is a great way of saying it, a collection of inbound and outbound resources, networks, connections, business relationships that are all required for the successful sourcing, marketing, sales, distribution of products or services to end users and customers, right? I mean, it's not just about marketing. Obviously, that's a very important channel. It's going to be the way you generate revenue more than likely, but you can't generate revenue if you don't have good channels that are getting your product to market, right? All the products we're talking about are going to take manufacturing and fabrication. That is a part of that. So whether you're doing that onshore or offshore or a combination of above, there's a lot of great onshore options now. There's always been a lot of great offshore options as well. Whether you're going to be working with a supply chain or you're going to be doing that on your own to cut out the middle person. But all those other business relationships and all those other connections you need to actually be successful at delivering your product or service to market. That's what a channel is. So that's what we're going to talk about in the next few slides. All right, so just to start off in some non-marketing stuff, just kind of set the stage there. Inbound upstream channels. I mean, these are like the material sourcing, third-party remote manufacturing, third-party product fulfillment, that's supply chain, third-party sales. Not everyone's going to have a sales team. You might actually go with an integrated sales network, an ISN, that will be, and they're professional salespeople. And all they do is they pick up products that they like and they start selling them. So you can actually hire these networks of sales people that just go out and sell anything that they feel comfortable selling. That might be something you do. You might actually partner up with a someone who's upstream from you that already has a market share, going back to the brand loyalty. There's one way to combat the brand loyalty, and then there's one way to kind of be the Trojan horse inside the brand loyalty, right? Do a revenue share, let them do all the fulfillment, all the heavy lifting, and you take a percentage of what comes after that. Now, that can really depend on who's doing the more work, who gets the bigger side of the revenue share. But a lot of ways, sometimes it's really good. I have 2 CEOs right now that are in the healthcare space, that they have other products and other businesses, but they also have patents and intellectual property, and they're looking for a general manager just to kind of deliver their product to market and take care of all these different things for them. So you can actually farm out a lot of your business sometimes as well, especially if you're going to use a larger partner in the same market space. And then, of course, logistics and distribution on the inbound side, right? Getting things in. Then outbound, downstream from you, logistics, distribution, again, to the outbound side, reverse logistics. What happens when a product goes bad, customer wants to return it, so on and so forth. There has to be reverse logistics. And don't count disposition out as well. That's the entire company of Overstock. How they started was the disposition of products that were sent back or overbought from a variety of different companies, right? And so Amazon does this. You can do this all the time. So disposition is also something to be considered. Your retailers, who's going to be selling those, whether they're value-added resellers, are going to take your product and add something to it. Direct sales, indirect sales, these are all parts of it. Customer service representation, which is also a sales mechanism. It's not just marketing opportunities and customer satisfaction. It's called upsells, right? They have the first and most generally best connection after they've solved the problem for the customer to then actually upsell them for more services. So this is all the outbound, downstream type stuff. So now we jump into marketing, and this is really important. So let me just finish up by saying the other 2 pieces, though, that are important about what I just talked about. I don't really think y'all need to spend much time thinking about all your inbound and outbound channels as it relates to the sourcing of materials and moving those materials out to market, right? Not for this cohort, not for this program, and not for the pitch deck. There are going to be some things that we talk about go to market, which actually we're going to cover in these next few slides. But don't worry about the other pieces. I put that out there just to give you an awareness of those. If we move your businesses outside of this cohort into more commercialization areas and opportunities, then yeah, you'll obviously have to think about those. For right now, for the deck, I just wanted to make sure y'all had some awareness of that. Okay, so let's talk about marketing, because we've talked about narrative, we talked about different things related to that, and it's all part and parcel of the same thing. A business methodology that attracts customers by creating valuable content and experiences tailored to them. Inbound marketing forums, connection customers are looking for and solve problems they already have, right? We just talked about those problems, pains, and gains. So there's a variety of different things. This is talking about inbound, right? So social posts, blogs or vlogs, podcasts, webinars, press releases. These are things you're going to put out into the air. You're going to put out into the market. that you're not expecting any, direct action from necessarily, but you're expecting exposure, awareness, and everything else. Now, if you get call to actions because you've put those in there properly and people come to you, that's inbound, right? So they're coming to you from something you've put out there in the market. Now, this little thing over here to the right, I'm going to send you a link from the HubSpot flywheel. It's a great tool to kind of think about how you're going to do things. So the first thing you want to do is attract customers. And that's how you start doing this with these social posts, blogs, vlogs. You become a knowledgeable person in the space talking about your product. You start attracting individuals. Even in webinars, you start educating. We talked about disruption and innovation, how sometimes, a lot of times, maybe even most of the times, you have to actually educate your market before you roll a new disruptive, innovative product into that market, even if you're offsetting or supplanting something that's already there, right? So webinars and doing things, gathering people, giving them information, teaching them, coaching them, do whatever you need. That's all going to be a great way for them to kind of be attracted to you. And with those things goes to the next side, which is engage, right? So once you've attracted them, you have to engage them as well and continuously engage them, right? You have to give them the pains and the gains that they need in order to really appreciate utilizing your product on a routine basis. Therefore, you can come up with a lifetime value of a customer that represents how much money you'll be making of it. If it's a one and done kind of thing, you got to make sure that's very profitable for you, but you're also burning through each customer each time, right? So engagement is a very important thing. And then I've talked about this last week, once you engage your customers, if you're not constantly looking for ways to delight them, now your product might just delight them on a daily basis, no matter what. Going with the farming thing, they're getting higher yield, less breakage, less loss. So the prevention is not as high as there. These are all things that are very delightful for someone. But as you move other products and more happens and markets open up for your products and your customers become conditioned with the standard that they already have from you, you have to continue to delight them. And then this is a virtuous cycle, right? So you have the attract, engage, delight, attract, engage, delight. And then on the outside, you utilize these are strangers, prospects, customers, and promoters. And that's very important. So when you're attracting their strangers, when they start to engage, their prospects, when they become engaged and they're delighting their customers, and then they're champions, right? Then they speak about you. Then they have the word of mouth. And that's a really important thing. So this is I know for a fact, as far as my opinion goes, the best way to encapsulate kind of your marketing approach to customers. It's simple, it's concise, and it leads to growth. And I think this is a good way to do that. So I'll send out the link. HubSpot's a great organization. It's also a tool you can utilize to help your business. All right. Well, I jumped ahead of myself. I guess I should have jumped to the slide and talked about it in this bigger format. So here we have it. But here's where I'm going to add some other things to just give you some examples. We talked about the attract, engage, and delight, the attract tools, right? So these are things like ads, video, blogging, social media, content strategy, SEO, whether it's, short format content that you're creating, whether it's LinkedIn posts, or whether it's Facebook groups, right? I'm working with a business right now that has 35,000 active users in a Facebook group, and they're building a product around that. That's 35,000 people that they've already attracted to their product concept. And when they started delivering on some of the values that were able to be delivered without a product, without an actual application for them to use, they were engaging those people and those prospects. And now they are actually potentially going to become customers, because when they replace the overall Facebook features that they're doing, all the content sharing and information sharing they're doing with an actual app, and build their own community around that, those are kind of locked in customers because they were part of the original engagement. And they've become very delighted because they're a part of it, but also they're seeing the value of what they already were expecting. And don't think for a second that those 35,000 people are not going to go out and tell one or two other people. Maybe it's not 35,000, maybe it's just 2,000, but 2,000 out of 35,000 telling two people each, right? You can see how that would grow. And even if 50% of those two people they did come in, or 20% of that, that is a significant growth, right? So that's why we do this virtuous cycle. So we start off with attraction tools, and we move into engagement. So now we're actually doing email engagement. We're responding to them. We're doing lead management by trying to generate new leads, either off existing customers or other customers. We're automating our marketing. We're spending a lot of time making sure our customer service representation is really on point. We also need to make sure our product's on point, because we don't want our customer service reps to have to be dealing with a lot of bad things, but they're there to do that, and they have the opportunity to upsell. Then delight tools, so smart content, things that are targeted to them, continuing to find out the value propositions and continue to add features to deliver that, and then continuing to engage those customers so they know what's the latest stuff. So smart content, social media listening, understanding what they're saying, customer service representation, again, chatbots. These are things that actually can interact with people on a more constant basis than an actual human can. So it can be a way to better engage them. So this is the HubSpot flywheel. The link's right there. I'll drop that in to the chat as well. In fact, Shelby, if you can go grab that link from HubSpot and drop that in the chat, I appreciate that. Okay, so here's some outbound TV, radio ads, cold calling. And no one likes to do cold calling. I don't like to do cold calling. My wife is a salesperson. She loves it. I don't get it, but it's very, very effective. Email blasts, trade shows, flyers, hangers, direct mail. I shouldn't say I don't get it. I understand why. I just don't like to do it. But give me an investor list and I'll call every one of them, right? So, and when it comes to sales, that's not my cup of tea. When it comes to investors, which is just sales, yeah, I'm good with that. So these are just things that you kind of have to build your skills around in order to continue to delight your customers. All right, any questions about channels and generally business development? All right, cool. The one last thing I'll say, because I didn't actually talk about business development in very distinct terms, everything I just discussed, that's all around business development. So think of business development as just formalizing relationships. Your customer is certainly one, but everything upstream from your customer is a relationship, unless you're going to do it all. And very few customers or very few businesses are able to do it all. You're going to need partnerships. That's all about business development. And when it comes down to the funding, that's also business development. And then when it comes down to finding someone that you could be an acquisition target for, a larger company, that is business development. Moving into that space, letting people know what you do, understanding that, forging relationships, reaching out to people in LinkedIn, doing whatever you can to kind of build and foster relationships that will help you succeed with your business. That's all related to what we just talked about. And that's all encapsulated in the term business development as well. Okay, Shelby just dropped that in the chat. Everybody at the HubSpot, it's a great little tool. Go grab it. And the flywheel is probably on inbound marketing, but yeah, just go to HubSpot. It's a great place. All right, so we're going to go into corporate formation. This might generate a lot of questions. We can talk about it as much as you need to. This is not something that anybody needs to worry about immediately. But if you decide to take this on, or your entities decide to push it further, or maybe you interest somebody, hopefully you interest somebody in our panel of investors and everything at the final pitch, and they want to move forward, you're going to have to think about this rather quickly. So let's go through it. All right. So what type of business should I form? And there's a new one that I won't spend a lot of time talking to about the crypto space, but I'll try to cover that real quickly at the end. So corporate formation types, we have the famous LLC, the limited liability company, S Corp, C Corp, nonprofits, sole proprietorships, and general partnerships. And we're going to go through all 6 of these. All right, so here's the easiest one to kind of understand and actually do. There's plenty of services out there. I use Zen Business all the time. They will actually form a business entity for me. They'll become my trusted agent to do so. They'll go and file the paperwork for me. And all I got to do is respond to them every year with an annual report and my tax information and stuff like that. And they keep maintaining it all. So there's a lot of companies out there that will do that. Lawyers will do this for you, or you can just do it on your own. LegalZoom and a variety of other sources online to help you. So what is an LLC? It's a business entity that prioritizes the separation of the people in the business and their personal liability. That's a big, huge thing there. Similar to other corporation types, on this list, an LLC protects members from being financially responsible for damages. If I don't have an LLC and I put a product to market and that product hurts someone and that person sues me, I'm paying all the liability out of my pocket. That's just it, right? I chose not to be protected in any way, so I have no protections in any way. An LLC will allow you to do this. You can put 5 members in it. You can put 50 members in it. You can assign who's the managing partners of it. And you can say everyone has an equal say. Everyone in the LLC is protected by the LLC to a certain extent. Now, if you're doing criminal activity and the LLC is doing criminal activity, no holds barred, you're going to get charged. But generally, if you're doing what you need to be doing or what you profess to be doing and what you plan to do, and it's not harming anyone and it's in legal bounds and ethical bounds, This LLC is what you need to kind of generally protect you from anything that goes wrong, because even though everything is going quote unquote right, there is something that's going to go wrong. There is going to be a customer that's so dissatisfied with your product, they sue you, right? You don't want them suing you personally. So an LLC protects the personal assets of the owners in the event of a lawsuit or any kind of financial damages. It's not expensive to do to set these up. Wyoming does it for like, I think less than $100. That's one of the new states that are like pretty much all the startups do their LLCs through. I have 2 through Wyoming. Delaware, we always hear that too. That's kind of an important state when it comes to incorporation, but Wyoming does incorporations too. Every state in the union does corporations. Many of those states will allow out of states to do it and not file any taxes if you're not generating any revenue in that state. I don't do any business in Wyoming, so I don't pay any taxes there. I pay taxes here, but I don't pay taxes for that, right? So there's a lot of things to know there as far as that goes. LLCs are quick and easy to set up. You can do it in a matter of days, just a filing going back and forth these days. I'd say it generally takes less than 10 days. I think probably more realistic is more like 5 to 7 if you're just kind of paying attention to the back and forth that you need to work with whoever's doing the filing for. So it's pretty easy to do, and it's very easy to protect. And you can also kind of start your business this way. And I think that's also important. I'll talk about this a little bit more as we go along. This is a great way to start. You will probably have to be a C Corp or S Corp when you take on large scale investment. But until that point, when you're taking on smaller investments, it's okay to be an LLC. You can open up bank accounts as an LLC. You can kind of get your founders involved at the right levels and understand what part each person plays before moving directly into options owned kind of incorporated space, right? So, or equity owned incorporated space. So it's kind of easy to deal with the earlier stages of startups in an LLC format. All right, so the less popular of the 2 corporations is the S Corp. There's subtle differences between the 2. A business entity that passes almost all finances through to its shareholders, and that's a big thing. It's like a corporation has shareholders. These finances include income and losses, as well as tax deductions and credits. By passing all these finances through to shareholders, S corporations are able to be taxed like a partnership, but gain corporate perks, right? So the liability and protection is there from a certain level of stuff, but with an S Corp, the owners of that corporation, the members of that are actually saying, I want all the benefits of gains and losses to come directly to me. That means all the tax deductions and credits also come to me. That means I'm also liable for paying all the taxes that I could generate through my business in this regard. But it also means that the partnership itself gets to take advantage of certain higher level stuff that a corporation would be. I don't have a lot of good examples or any good examples of an S corporation because there's just not a lot of them that I know about. I think most of them are C Corps. I mean, by statistics, yes, most of them are C Corps. In this one, though, the shareholders of the corporation are responsible for the income loss and acquired tax liability of such. So this just pushes the liability from the financial tax side of things and a few other things directly to shareholders, and the shareholders will share that across the board. All right, so this is the more popular one. This is, generally when you see the INCA behind some of these companies' name, this is what they formed as a C Corp. And you'll hear it like you have to form your C Corp in Delaware. That's not true. I think at one time, it really was kind of like the check box that you would do or the tick box that you would tick off just to say that you were a Delaware-based C Corporation. It gave you a little bit of validity. Really, everyone knew it was just a place for Delaware. Delaware did it very early on. They got, everyone, including the FedExes of the world, to do their C Corps out of there. Everyone just did it. The investors kind of saw that as like, oh, you need to check that off. Oh, you're not a Delaware business. These days, it doesn't matter. Everyone does business everywhere around the world, and you can establish a lot of different things, and especially, as you're going cross-border too. So these C Corps, these are and S Corps and LLCs, these will protect you on U.S. domestic territory. You will need certain things to actually do out-of-zone sales into international markets. In some of those cases, you might need another version of your business that is aligned with their legal entities around corporations and stuff like that. So just know that this is just really relating to the U.S. markets, and it can allow you to move in international markets, but you have applications there that you'll need to pay attention to, considerations. So a corporation is able to take advantage of certain tax benefits, chief of which is that the profits of the company are taxed independently of the profits of the owners. If your plan is to grow your business and eventually sell it, a C corporation is the best method to keep your personal assets a separate legal entity from a professional corporation. So dividends and profit sharing and everything you make from your business, those become to you as personal income, and you'll have tax liabilities related to that. But as a business, if there are no dividends, no more profit sharings, and you're just making your normal salary or whatever it is, then you don't have to worry about it. Everything that the business generates is going to have to actually be taxed upon itself. All the revenue, all the different purchases, everything that it would be, including all the deductions that would be given, and all the other loopholes or otherwise that a business gets to go through. Those are all part of the business. So the business is protected, and you're an extension of that business that doesn't need protection because you're simply an employee, or maybe you are an owner with equity, but you're not libelous for what's going on in the business unless it's something criminal or something like you're baking, you're cooking the books. I mean, I'll give you a few examples, or at least one, like Enron. If everyone remembers Enron from now 20 years ago, they were cooking the books, and this has happened time and time again. Things like, Morgan Stanley and doing short sales and stuff like that through 2008 and stuff like that. They got a lot of fines. They paid the penalties, but the corporation is the one that really took care of that, not the managers of the corporation. Unlike Enron, where they did something highly illegal, cooked the books in major ways, and they were all fined. The top suite of executives, many of them went to jail. Many of them were not just fined, but were very much charged with a lot of different things because they really decided that they were going to, pardon my French, screw their customers, screw everyone else, right? And so they did very criminal things, and nothing can protect you from doing that. So if you're a CEO and you're doing criminal things, the C Corp and an LLC or an S Corp or anything is not going to protect you. All right, the corporation itself is responsible for income loss and the required tax liability as such. All right, nonprofits. This is a corporation that is similar to the C Corp, but generates no profit and is tax exempt. A nonprofit organization must be created to support a specific cause. Generally, that's public, specifically for members of the nonprofit or groups of people. We all know examples that most every church that you might attend to is a nonprofit. They don't have to pay taxes, right? They can use that money in a variety of different ways that are all aligned to the general mission of their church or their faith, right? Whether that's community engagement or that's building a new rectory, right? It doesn't matter. It's all related to the way they take in money, which is usually through tithe or donation or whatever it is. And then they can use it in any way they really want that supports their operation and their mission, and they're not going to pay any taxes on it. So it's a really great way. Now, it's not easy to get a nonprofit. It can take several months to get your nonprofit status, even longer. You definitely should work with an attorney to get your nonprofit status. This is not something I recommend you stepping into all by yourself. There is a lot of resources online, and you can do it by yourself, but I do think this is one of those things where an expert can help you get it done as quickly as possible. A nonprofit should be run like a for-profit, though. That's one thing I want to stress here, to maximize inbound assets, and revenue opportunities. Just because you're a nonprofit doesn't mean you have to act like that, right? And you're not literally a for-profit, because profit actually means something else. But the more money you generate, the more money you can bring on, even if you can sell a product underneath that nonprofit. That just means you can expand your impact, right? So thinking about it as from a profit potential, and it really, what I think about this is like, if you had a bunch of shareholders, which you wouldn't in a nonprofit, they'd be expecting you to do the right thing to maximize their money. Donations are no different, right? Most people, in fact, Memphis is one of the highest donating cities in the country. Average of 6% people donate 6% of their income towards charitable groups inside of Memphis. So the idea there is like, that's money coming in. You should have a responsibility, accountability to the donors to do the best you can to maximize the opportunities for that donation. So considering businesses that are nonprofit, but treating them as a for-profit kind of focus and a management style is very, very important. Much recommended. Okay, sole proprietorships. In a sole proprietorship, the business and the person are the same with no legal separations between the two. This person is personally and financially responsible for any debts or damages. Generally, these are professional services type people. These are just they got a business entity around their overall intellectual property, which is their coaching or their therapy or whatever it is from professional service, or a lawyer, right? If it's a lawyer, it's their own jingle. They have no partnership. They're a sole proprietor, and that's it. Some retail businesses are also like this. So you could go this route. I don't think this is the best route. I think the LLC is a better route to go, but just to know that this is out there. And then it's general partnership. This is really where we're talking about like VCs form these and hedge funds and different things like that. A general partnership is similar to an LLC in a lot of respects. and that the members can structure the business as they see fit. But in general partnerships, all profits, legal obligations, assets, and losses are shared from the members, the partners, the general partnership. And there's people that have limited partnership as well, but they're still kind of part of the mix. So everything that happens in there from a profit and loss perspective, any legal obligations, even though there's a general entity that covers the group as a whole and sets forth kind of the operating procedures of how they do things like voting and board and everything else, they and how they'll spend the money. That's a big one for VCs. They're all part of it, but anything that the organization makes, they all are liable for the legal obligations, profits, and so on and so forth. So all members of a general partnership are responsible for any financial and legal damages with their personal assets at risk in the event of forfeiture. Okay, let's look ahead real quick. Okay. All right, so some considerations. We talked about this earlier. Good recommendation, form an LLC first. This is in the concept stage. This next bullet actually goes along with that. Creating a pre-incorporation agreement. I have a great example of that if anybody's interested. This is just an agreement that you'll make between your founders. It is binding between your founders as far as an understanding of who does what and why and who owns what. And then it also becomes part of an incorporation document, but it's not needed as part of the LLC. To me, this is a tool that's separate from that kind of says, here are our founder core, and here's what equity each one will share, and here's the general areas of responsibility. And yes, all four of us that make up this founder group agree to this because we've all signed it, right? So it's a great way to start off your founder kind of situation, because we have a term called founder divorce, right? Where founders go into this thing 2 or 3 months later, they get very disillusioned by what they thought was going to be the case. They get aggravated, somebody who's not pulling their weight, or someone who's stealing the light or doing whatever, or really focusing too much on the product, what have you. This is really that part where, having a good understanding at the forehand kind of helps that along the way. So a couple other things for an LLC and a corporation. So the IP must be assigned to the legal entity. I know a lot of people on this actually are, IP holders, right? Patent holders on these things. When you form a business and you're trying to commercialize that product, first of all, your name will never be removed from that patent. That patent is always going to be your creation, but the business should own the patent. If I'm an investor and I want to invest $1 million into something that's patented, but the main founder has a patent and it's not owned by the business asset, that person could leave anytime they want. What's the lock of the intellectual property? If they leave the intellectual property, then I have nothing. Maybe they're licensing the intellectual property to the business. To me, that's not good enough either, right? Is it an exclusive license? I might be able to be aboard on that if we have some more control of the whole situation. If it's a non-exclusive license, there's no difference than that person going and selling it to anybody else. So that puts more risk on my investment as well. So the IP must be assigned. Vesting by all founders is critical. Vesting is like, you don't get your equity all up front. You might vest your equity over 2 to 4 years. A standard is 3 to 4 years. So where in the first year, you have no vesting until the end of the first year. And at that first year, you get 25%. Second year, prorated quarter to quarter, you're going to get that next 25%. Third year, the next 25%. And at the end of the fourth year, quarter by quarter, you'll have had everything and you'll have 100% vesting. What that does is that locks the founders in, right? And that's very important for investors as well. Now, there's all sorts of triggers that can happen. Like if you sell the company in the second year and you've only invested 50%, guess what? Bam, magic, you're 100% vested before the transaction takes place. There's all sorts of things that make things come to fruition much quicker than what they were originally planned when it comes to a business. You might even recast your business into something else. You might merge with somebody else and you need that stuff to be vested immediately, because you don't want vesting stuff on the cap table when you're actually trying to supplant one type of one type of stock with another, with someone merging and someone taking over the stock, right? So there's a lot of reasons why to vest. I have had to go through these several times in my life where I have come up with something and I'm in a garage, I'm building a product, and then I have to form a business and I have to say, okay, this is not my product anymore. This is the business's product. But for me, that's where you need to move to, right? You got to focus less about what you own and more about what your business needs to own, so it supports the success of your business, because you are going to get a return on that, right? If you start this thing off and you have 3 founders and each of you have 20%, it does get diluted over time because you have to make space. But I always say that I would much rather have a small piece of a really large pie than a large piece of a really small pie, right? And that's the kind of mentality you have to start getting yourself kind of accustomed to when you start moving into these corporation considerations. Okay, any questions about business formation? Okay, homework time. Okay, so 2 things, all right? And I know I haven't asked you anything about competitive analysis yet, all right? But this is also, I'm not going to say it's a no-brainer because it does take brains, but it's one of those things where it's not overly difficult to do. Here's my challenge, all right? I want you to build a spreadsheet. It doesn't have to look like this, at least now. We're going to make it look like this before we put it in the pitch deck. If you have no competition whatsoever and you can defend that assumption, then you don't need the slide. You can have a simple slide that says, we're the one and only. But I don't think that's going to be the case for all 3 of y'all. There's either a product that's already in the market that pales to compare to yours. So when you're saying it is like, I've invented something that is so good and I have the patent on it, no one else can invent it. Okay, well, that's great, but you're still trying to offset someone who's already in the market. They are competition. They have the sales and you don't, right? You have to go get them. So they're competition. Also, just looking at things that are in the same space but aren't directly related to you is okay as well. It has to have enough of connection for it to be considered competitive, but you just need to know, I've either had direct competitors or kind of loose competitors, or just I'm trying to supplant something that is so old and archaic. And I've got something so brand new and innovative and disruptive, but I still have to offset that customer from them onto me. So I want you to think about this. I want you to take a little time with your team. Each of you all do it individually and together, just divide and conquer if you need to. Look at the market, go to Google or whatever one you want, and really look to see what competitors are out there. Now, that's one thing. You also need to kind of start coming up with the top 4 or 5, 3 or 4 top features, top things you're providing, top of the value proposition, right? And it can be things that they do poorly and you do well, right? So you need to really set the stage for your competitors of how much better you are than them, right? I like to use big green arrows when I'm doing these things, and usually I have red X's in there too, just to really draw a negative connotation towards my competition. Because this is all trying to gamify your audience to believe that your product is better than anyone else's, because it is, and these are the reasons why. So first part of the homework, come up with a simple competitive analysis matrix. We're going to spend a little time on this next week. There's no right or wrong answers as far as this goes. Do some research. If you come up with nothing, let's talk about it. I maybe can challenge you to think of something a little bit differently. And if it's truly nothing, we'll figure out what to do about that. But I'm willing to bet you all have a little bit of competition. So that's one thing. Then the next thing is to create a 60-second elevator pitch. It doesn't have to be overly clean. We're going to do this over the next couple of weeks, right? But between now and then, I want you to take a stab at what we talked about at the very beginning. You have the problem, you have the customer information, you have the solution information, you have the value proposition information, and now you're about to have some competitive information, right? Putting all that together, and you don't have to worry about the competitive unless it actually adds some compelling narrative to your elevator pitch. But putting those first 4 pieces together is everything you need to get to your elevator pitch. It's not everything you need to get to your final deck, but it certainly is everything you need for an elevator pitch. So take a stab at writing a pitch script for that. You should probably, in this period of time, also start reading the script over and over again, just to make sure it's as concise as possible. The video, we're hoping you can get all that done in the next 2 weeks. That's kind of when the homework assignment is due, is not next week, but the next week, 2 weeks from now, to get that video in. So you might want to start recording it. You at least want to start timing it. Now you can start that after we go over the script next week for homework review, and then start recording it afterwards. And we'll talk about the video in more in depth next week as well. But I want you to go ahead and start taking a stab at drafting up your first elevator pitch script. Okay. That is it for this week's programming. We had a great presentation from Andrew. Hopefully y'all got a lot from that, at least just an awareness. We talked about the channels and importance of inbound, outbound, and business development, and everything is business development, including sales and otherwise. And then we also talked about corporate formation and kind of the different business entities that you need to do some research on and figure out what's best for you if you move this into a commercialization opportunity after this, which we hope you do, and which we're here to help you do. So we'll provide more information. Andrew has already given me the documentation, and that's up in a folder on the Google Drive that everyone should have access to. I'll make sure that's there. Obviously, the deck is going to be put up there as well in the weekly sessions. And then once I've generated the video from this session, we'll put that up there as well, up on the YouTube channel. I'll open it up generally for any statements, questions, or otherwise, and then we'll conclude. Okay. We have office hours tomorrow. If anybody needs them, 3 to 5, go to the sign up sheet in the Google Drive. If you just would rather pass things back and forth through email, that's great too. I have to say again, we have had not anybody that I know of sign up for office hours in the last 3 weeks, yet y'all are producing high quality stuff. So I think y'all are very receptive and participating, and I think that's great. Hopefully we're doing a good enough job, and it seems like we're doing a decent enough job to actually get the information to you so you can understand it. And it's great. So every time I see the homework, it's like spot on. So I really appreciate that participation and that attention to detail. And we're here for you if you need it. So if you don't want to sign up for office hours tomorrow, just can't do it, bad time, just reach out to us in email. Okay. Well, then I'm going to conclude this session. I really appreciate everyone's time. Have a great rest of your Thursday night. Got 10 minutes back to your schedule, and we'll meet next week.